Very good. All right, wonderful to see everyone here today. Thanks for taking the time to join me. We today will talk a bit about, briefly about how Squirrel's going and some things going on with our business. That'll just be brief. And then we'll move into how the New Zealand housing market is going and how the Squirrel loan book is performing. So you'll have an opportunity to ask lots of questions. Don't be afraid to type those questions in the Q&A box or in the chat box that you can find on as part of your Zoom menu. Always much better if we get questions and make things a bit more interactive than simply me blathering on at you for a period of time. There's about 20 to 25 minutes of prepared content for today's sessions, and then we'll move into Q&A. And Q&A, I'm happy to stay around and ask as many questions as people would like to ask, and topics or anything to do with Squirrel and investing today, as far as questions that you can ask. Very good. Without further ado, let us move into things. All right, so I promised an update on Squirrel to begin with. So over the last 12 months, Squirrel has settled about $1.6 billion worth of home loans. The vast majority of those have been with major banks in New Zealand, but we've also settled some to ourselves and also to non-bank participants in the market. Squirrel investors, or investors who have invested with Squirrel, have collectively now invested over $70 million, which is a substantial increase, about double where we were this time last year, and we're expecting to see that growth carry on. As part of that growth, we've actually expanded our leadership team. So we have a new CEO who will be starting with us in July. His name's David Cunningham. Prior to joining Squirrel, he was the Chief Executive Officer at Cooperative Bank in New Zealand. We've also appointed a Chief Risk Officer. A Chief Risk Officer, some of you may not have heard of that type of role before, really important role in a financial services institution. And their job is to manage things like credit policy and our operational risk that goes along with managing lots of people's money. Tony Lane's has joined us, so he's actively started. And if you look back at his CV, one of the roles that he held was the Chief Risk Officer at BNZ, which is great to have Tony aboard. We very recently raised $2.5 million in new capital, which supports the continued growth that we're expecting to have here at Squirrel. And ultimately, that's going to help us get more Kiwis into home, which is what we're all about. Last but not least, we're approaching the end of our financial year. So audited financials for our business and a custodial assurance report will get published probably in July. I think that's when those documents will be available. So we'll publish those once they're available, which will give you a bit more of an insight into our wider business and how we're tracking. Okay, there we go. So that's an update on Squirrel. Let's move in now to the New Zealand housing market. So I think it would be fair to say that balance has returned into the supply-demand equation, having for the last sort of 18 to 21 months really run with an excessive demand relative to supply. So there's a few things that have changed that balance. So first of all, clearly the Omicron outbreak has led to less people being out and about, less people at open homes. I'm hearing reports of no one turning up to open homes in Auckland, or only one or two parties to some open homes, which is quite a turnaround from where we've been over the last 18 months or so. Second thing that impacted the market, so there was triple CFA, which is lending legislation for consumers that was introduced on the 1st of December last year, and LVR restrictions that the Reserve Bank introduced or reintroduced, is probably the best way to describe it, in November last year. So both those two things have depressed demand somewhat. There's one little tidbit here around pre-sales of new developments. So with the changes in triple CFA, that's made it harder for banks to approve people that are willing to buy off the plans. Often it's first home buyers. And that has made things a bit harder for those first home buyers or those people buying off the plans. which means that it's harder for developers to get pre-sales on a development that they're looking to begin. And often the developer can't get started until they have a certain level of pre-sales in place. So that's one downstream impact that will come home to roost during the course of this year as developers find it more difficult to get new development started. For developments that are already underway, the vast majority have already got their pre-sales locked in. And so we won't see that impact on existing developments, and new ones, it's just going to be a bit harder to get them off the ground. 3 other points here. So first of all, materials are clearly being held up in different ways, shapes and forms. You've probably seen, heard or read about jib shortages around the country at the moment, and some of the crazy prices that a sheet of jib is going for on Trade Me right now. We've also seen interest rates starting to rise. As investors with Squirrel, you're starting to see the benefits of that, particularly those that are invested into home loans and construction loans, with an interest rate increase that's kicked in for your investments as of yesterday. Last but not least, we've seen house prices pull back from their highs, and I'll talk a bit more about that in a moment. The graph on the right-hand side of this page, the orange bars show the quarterly sales volume of houses in New Zealand, courtesy of REINZ data. You'll see I've shown information on that timeline for the post-GFC period, so February 2009 through February 2011. And you can see that the volume of houses selling each month was tracking at sort of 13 to 14,000 each quarter. If you look in more recent times, clearly there was a large volume of sales going through in the February 20 and February 21 quarter. And that was when demand was outstripping supply and people were buying houses left, right and centre. If we look back to pre-pandemic though, to February 2019 and February 2018, in those quarters, actually what we're seeing in the February 22 quarter is that house sales volumes are actually similar. So while you've seen some headlines that may have said, house sales are off 40% from their peak, well, that may well be true, but they're actually still running at around the level of pre-pandemic, at a pre-pandemic rate. So actually, it's not quite as doom and gloom as some people may have pitched it so far. That certainly doesn't give you a view on what might happen in the future. There are signs of softness in that market, and so maybe we'll see things actually pull back a little bit further as far as house sales go. However, the data to date doesn't show that. All right, moving on to our next slide. So let's talk about who the borrowers are in the housing market at the moment. Graph on the left, data comes from the Reserve Bank of New Zealand, which shows a split between owner-occupied buyers, investors, first home buyers, and those borrowing for business purposes. You can see over a long period of time, so what have we got there, about 7 years worth of data, you can see the volume of houses being purchased by investors has actually shrunk during that period. So despite what some people might tell you that investors are out there buying every property under the sun, it's actually not quite true. Over that same time period, we've actually also seen first home buyers increase their share in the market. So you can see that grey line near the top of that graph, which shows an expanding share for first home buyers. I suspect first home buyers may go off the boil a little bit further just over the next 3 or 4 months while they sit and wait and see what happens with prices. And also it's been a bit tougher for some of them to buy because of those changes in the CCCFA lending legislation that have been introduced by the government. On the right-hand side, the graph comes from REINZ and shows house sales for, median house prices for Auckland and the rest of New Zealand. One big caveat to this data, I don't like medians as a gauge of house prices. I don't think it's a particularly good way to measure the way house prices are moving in the market. If you get, for example, a large tranche of apartments selling in a particular month, that's going to pull that median down. Equally, if you get a higher volume of higher priced houses selling in a particular month, it's going to pull that median up. So it's a bit volatile in my view for measuring month to month. But if you look at it over, a 2 or 3 year period, then it does start to give you a gauge. What it shows at the moment is house prices in Auckland are off about 8% from their peak, which was kind of October, November last year. And certainly no sign of a decline just yet in the rest of New Zealand, although you would say at best house prices have probably stabilised. So if you draw a line from about July 2021 for Auckland, then house prices have kind of been flat from that period, albeit some peaks and troughs in there. They've been up a little bit more in the rest of New Zealand, but that last little peak that you see right up the very right-hand side of that orange line, I suspect will pull back a little bit over the next wee while. All right, so take that median house price data with a grain of salt, but certainly it looks like house prices have come off a little bit, certainly in Auckland. Okay, I'll keep rolling on here. So we've got a softening market. What does that mean for managing credit risk? And given that investors with Squirrel have invested into loans from the housing market, I think this is a relevant topic for us tonight. So first thing to remember is obviously all investments come with risk. I don't need to tell you that. If we think about investments with Squirrel, whether it's our direct term investments or whether it's through our managed fund, then the primary risk to think about is credit risk. So that's primarily talking about the risk that a particular loan or set of loans will default in some way, shape or form. And that could be that people have stopped making loan payments, or it could mean that they've completely defaulted on their loan and effectively walked away from the property. So that is known as credit default risk. So how do we manage credit default risk from a Squirrel perspective? And I would say if you ask the same question of a bank, they'll pretty much give you the same types of answers. So first thing is credit policy. And you write a credit policy based on bad times, not on good times. You certainly don't write a credit policy thinking house prices are going to be rising and everyone's going to pay back their loans, on the basis with which you write them. You write it with bad things happening in mind. So if you go and if any of you know a credit manager out in the world, they tend to be a bit doom and gloom on things, even in the best of times, because they're worried about what will happen when things go wrong. And so the best credit managers often have some grey hair, much like myself, and have been through the property cycle a number of times. So some of the things that a credit manager will look at and think about from a credit policy perspective: loan to value ratio. So that's the first of those 4 points there, or LVR, you'll commonly hear it referred to. So LVR looks at how much loan there is on a property and how much equity the owner has in that property. So if I created an example for you, let's say it's $1 million house with an $800,000 loan, that would give you an LVR of 80%. So the borrower has $200,000 of equity and they've borrowed $800,000 against that property. Second thing is affordability. So how is that individual or the builder or construction project going to afford this loan? So regardless of whether it's principal and interest or interest only or interest capitalizing, they've still got to be able to afford it, and the loan still has to make sense. So we've got to think about affordability. And that has different ways to think about that depending on the situation. Third thing, so from a Squirrel perspective, as you'll know, we don't write loans for 30 years and expect the borrower to pay that loan off over a 30-year period. We're writing loans for much shorter periods of that. Typically, it means that there's going to be an exit strategy for that loan. And so we're assessing the viability of that exit strategy. So in the situation where we're lending to a builder, for example, what's the chance that builder is going to sell that property at the end of the process? And they may well have pre-sold it on the way in. So we're looking at how they're going to exit that loan and the viability of that particular exit strategy. Fourth thing we think about is diversity. One of the things from a Squirrel perspective that we really focus on is trying to get a large number of loans on our books rather than a small number of large loans, if that makes sense. So with a maximum loan size for our home loans and construction loans of $2 million, it means we can't go wild and crazy lending to large scale developers. That brings, if you were to do that, that brings a much higher level of risk. So if we look at our construction loan portfolio today, there are 60 active loans in that portfolio. the chances of all 60 loans going bad at the same time is remote, to say the least. So diversity in the loan book, we believe, is important. Okay, moving on. The other thing that we think about is proactively provisioning money in the event that things go bad. Okay, so I imagine that most of you will be familiar with the fact that Squirrel has a reserve fund sitting behind each of our 3 investment classes, and we proactively provision money into that. So as a loan's paying its way, part of that payment that they make each month or each fortnight goes to the reserve fund. And it's there to try and manage the credit risk against loans. So if we look at our targets for how much we're provisioning on a loan-by-loan basis, for home loans, it's going to be roughly 0.3% or 30 basis points. For construction loans, that's going to be around 0.6% or 60 basis points, reflecting that there is more risk there. And last but not least, we've got personal loans, where we're reserving around 2% or 200 basis points, once again, reflecting that there's higher levels of risk. So as you walk up that risk scale, we'll proactively provision more money into the reserve fund. With many of the things I've talked about on this page, there's lots of information both on our website and in the investor booklet, which you can find on our website, which talk about our reserve funds, talk about credit default risk, and the other risks associated with investing in loans. So I do encourage you to go and look at those resources that are on our website to help you understand it. And of course, feel free to ask me some questions. Not afraid of an early question or two as we go through the session today. Okay, next point that I'll make is about measuring credit default risk. So it's actually something you can measure and can plan for. So let's talk about how we measure it. So first point here is credit default risk can be measured as probability of default times loss given default. So I'll walk through an example to explain exactly what I mean there. So if we talk about probability first, so what's the probability of a particular loan likely to fall over or likely to go into default during the course of its life? For this example here, I've said 3%. So let's say 3% of loans will default over a period of time. That default rate will vary a lot depending on the type of loan that's made, how much security there is with that loan, and a whole bunch of economic factors like, well, what's the unemployment rate, for example. So probability is the percentage of loans in a particular portfolio that are expected to default over a period of time. Let's move on to our other indicator, so loss given default. So what happens when a loan actually defaults? Well, the lender will try and recover as much of that loan as possible. And given that Squirrel primarily focuses on lending against residential property, I'll use an example here. So let's say Squirrel lends $800,000 on $1 million home, and then property prices drop 20%. So all of a sudden, the value of that home is now $800,000. The borrower has lost their job, can't afford the loan, and effectively that house is now moved to a mortgagee sale position. At that point, Squirrel would sell the property and claim back whatever's left over to recover against that loan. So let's assume that there were $40,000 of cost associated with selling that property. So real estate fees and legal fees would be the primary factors. And there's also a bit of time, a house sale doesn't happen the moment you list it on the market. So the example is that we started with a house value of $1 million, it dropped 20% to 800,000, and then it went to mortgagee sale. So it actually did default, and there was a $40,000 loss there. So that means of the 800,000 loan, 760,000 was recovered. So using that example, that would mean you've got a loss given default of 5%, which is 40,000 divided back through the value of the loan. So there's your probability and loss given default. So if we multiply the 3% and 5% together, it gives you a credit default risk of 0.15% on this worked example. And then you can compare that 0.15% back with the amount that Squirrel is provisioning into the reserve fund. So I'll make that link between where credit default risk and what you plan for, and how much you're reserving, what's the value of that reserve levy that's going into the reserve fund. Okay, so there's I guess, credit default risk 101. So let's talk about some New Zealand and overseas data then for a second. So first of all, it's hard to get hold of New Zealand data at a market level for credit default risk. The Reserve Bank started recording this at a market level in 2014 or mid-2014. So I've got some data on the next page, which I'll show you in a second. There is some overseas data though. And so, just to scare everybody for a second, if we use an example that during the GFC in Ireland, that was an absolute basket case in the residential housing market. So probability of default was at 5%, which based on, I'll call it modern times, so from about 1990 onwards, around the world, that was an incredibly high rate of default that was experienced. To put that in perspective, for New Zealand during 1991, which was kind of our worst housing-related recession, the probability of default was more like about 1%, give or take, in that situation. So why was Ireland really bad? Well, there was a few factors. So first of all, there was a massive oversupply of new property. So large volumes of development happening, particularly in Dublin. Second factor was all of a sudden they went from really strong employment to really strong unemployment. So we saw lots of people lost their jobs during that GFC, particularly in Ireland, and they just couldn't pay their loans. The third thing that happened was there was a massive run up in prices and then a massive run down in prices during the GFC in Ireland generally, and particularly in Dublin. So yeah, that probability of default, if we look back around other countries, at the most extreme end, you see something like 5%, where you've got a property market that's kind of similar to New Zealand. And more generally, 1% would be a pretty high rate, certainly over the last 20 years from a New Zealand perspective, and far more likely to have been sitting about 0.5% at its worst in New Zealand in the last 20 years. From a loss given default perspective, the big factor here, certainly from residential lending, is house prices. So the vast majority of loans in New Zealand, the loan to value ratio has a maximum around 80%. There is some lending that's done above that level, typically only to first home buyers. And in those situations, the things that a lender will worry about is house prices. So if house prices fall, let's say unemployment goes bad and the borrower can't afford to pay their loan, well, then there's potential for loss to creep in. However, with the restrictions that the Reserve Bank's brought in, you would say that on average in the New Zealand market, there's pretty low levels of risk at a market level. All right, so takeaways from that page: you can measure credit risk. We do measure credit risk, and we do set our reserving rates appropriately to the credit risk that we're taking. Moving on. This is the last slide that I've got to talk to, but I will spend a little bit of time on this one. So first of all, I'll talk to market performance, and then I'll talk to Squirrel performance. So the graph that you can see on the right-hand side of this page here, this graph shows a few different things. What I'll do is I'll start with the blue bars on the graph. So I mentioned earlier that the Reserve Bank of New Zealand has been tracking the net write-off rate, or the net losses against houses at a market level in New Zealand. So if we go back to December 2015, about 56, 57 million in that range was written off over the course of a year by New Zealand lenders. If we look through to what's happened to that blue bar over time, you can see it's reduced. And I would say there's a few factors in there. One of those factors is that house prices have been heading upwards, so the chances of a lender carrying a loss reduce. The second thing that's happened is the market's been pretty benign. Clearly, COVID's had impacts in some sectors of the market, but generally speaking, with rising house prices, it's unlikely you're going to see large levels of write-off occur. Another factor in that mix is the Reserve Bank became more aggressive with the use of loan-to-value ratios and demanding that certainly all the banks in New Zealand have to adhere to a maximum LVR of 80%. And for property investors, at the moment, that's a maximum LVR across their portfolio of 60%. So that demands a lot more equity in loans. And the Reserve Bank's argument for that is that it starts protecting the systemic risk of a significant housing downturn in New Zealand. Right, I'll take a breath. So that's the blue bars. Oh, sorry, last comment on the blue bars. At the far right there, you can see that in the last 12 months, so in the year to December 21, total of $4 million have written off by banks over that year. Let's put that in perspective. So the New Zealand housing market has around about 330 billion of loans, of home loans, that are outstanding today. So the best way to compare the write-off rate or the amount written off is back with the size of the market in each of those given years. And that's represented by the black line on this chart. So if we look back to December 2015, that equated to 4 basis points or 0.04% of home loans were written off over that 12-month period, or the loss, the amount that banks lost against home loans. If we compare that to December, the last calendar year, then the actual amount written off at $4 million compared to the market size of 330 billion was 0.001%, or 1/10 of a basis point, which basically is so low you can't measure it. So it was an incredibly low amount that was lost in that last 12 months, certainly helped by rising house prices, I might add. So that's what's been going on in the market. Now, unfortunately, I'd love to have this series going back to the mid-80s, and it would be far more revealing, I suspect. However, we have only got this data going back to, it started being recorded in June 2014. Two other items on that graph. So you'll see the yellow line on the graph, yellow dotted line, and the grey dotted line. They represent the amount that Squirrel is reserving against its home loans and construction loans. Okay, so we've seen since December 2015, maximum of 4 basis points written off by the banks. Squirrel's reserving for its home loans at around 30 basis points today. And for our construction loans, we're reserving at around 60 basis points, give or take. And that's kind of our target level, is what we aim to reserve at for the portfolio. So hopefully that gives you a view of where the market's at and then where Squirrel's reserving, which brings me on to then the performance of Squirrel's loan book. Okay, so the table at the bottom, the lovely bright orange table at the bottom, shows Squirrel stats for our lending book. So we'll start with home loans. We can see the 3 different investment classes there: home loans, construction loans, and personal loans. Lifetime levels of loans written, so 44 million home loans written in the 3 years we've been writing, 122 million for construction loans. Once again, it's over a 3-year period. And for personal loans, 64 million, and that's been over a 6-year period now. From a portfolio perspective, the active loans in each of those portfolios today are 13.6 million that are funded by retail investors, 40 million for construction loans funded by retail investors, and 12 million for personal loans funded by retail investors. And that data was as at the end of February. Portfolio LVRs. So I've talked about LVR a few times during the course of the session so far, and the importance of that from a credit policy perspective. For our home loans at a portfolio level, the LVR in the portfolio is at 65%, remembering the maximum loan that we will write is at 80%. For construction loans, that's actually around 60% today. Not relevant for personal loans. Obviously, around 90% of the loans in our personal loan portfolio are secured, but LVR is a much more difficult thing to measure in that situation, so we don't try, basically. moving on, so what's the arrears rate in the portfolio? So for home loans and construction loans, it's 0. And we've never had a loan go more than 30 days in arrears. In fact, I don't think we've had a loan that's been more than 7 days outstanding on a loan payment that is due. And there was just one loan that took about 6 or 7 days to recover. And that was one that got into a bit of trouble through that initial COVID lockdown period. Personal loans is a bit different. So you can see that there's a 3.4% arrears rate for personal loans. That's about our portfolio long run average. So there's nothing untoward there from what we've seen in the past. And if I compare that 3.4% to the market arrears rate for personal loans, we see data from Centrix each month, which shows what the market arrears rate is for personal loans. Market rate is around 7% or over 7%. So for Squirrel's personal loans, they run at about half of the level of the market rate, just for perspective there. From a lifetime default rate perspective, so this is that credit default rate that we've discussed during the course of this presentation. So for home loans and construction loans, we've had no loans go into default. So the rate is 0. Not much I can talk about there because it's 0. That is a good thing though, and long may that continue. For personal loans, that lifetime default rate is around 1.2% today. If we look back over the 6 years, at one stage that was up around 1.4%. We have taken a more conservative stance on our personal loan portfolio over the last 24 months, and we're starting to see the benefits of that. So I'd expect that lifetime default rate to continue to reduce over time. Last column in this table looks at the amount that we're reserving. So what's the average reserve levy or the target reserve levy? For home loans today, it's around 30 basis points. For construction loans, about 60 basis points. And those two items were mapped on that graph above, if you recall me talking about that. Last but not least is our personal loans. So for personal loans, we reserve at about 2%, or about double what that lifetime default rate is. Just to give you that perspective there. So that gives you an overarching view of our loan portfolio. We keep lots of data on our website. So you can see the current state of play on the vast majority of this information on our website, updated either daily or updated monthly. On the main investments page, you'll see things like what the target reserve or what the actual reserve levies are running at. You'll see the size of that portfolio, and you'll also see the coverage ratio. So how big are the reserve funds relative to the size of the portfolio, which I think are relevant stats to look at. On the loan defaults data tab on our website, you'll also see a lot of information on all 3 investment classes, which describe current arrears rates and the number of loans in default at any given time, those sorts of things. So if you're into data and looking at the stats, feel free to dive in there, and there's a huge amount of information that you can look your way through. All right, that brings us to the end of the prepared information in the portfolio today, and we're going to move into the Q&A section. So you can get started typing furiously at this point. So here's a question. From Henry, a bit off topic, mate. Had a question about matching of orders and whether smaller orders get matched faster than larger. The answer to that, Henry, is no. It's a time-based order queue. So if you place an order, you will find your place in the queue, and then we literally fill orders from the beginning of that queue, regardless of the size of that order, all the way through to the end of the queue. So you have someone with $500 has as much power in that queue as someone with $1 million that's sitting in that queue. Thanks for that question, Henry. So happy to take questions on anything to do with Squirrel investing, despite the fact we've talked about the housing market and how the loan book's performing today. Follow-up question. Do you hold smaller loans for approval until they have enough to match a larger order? The answer is no. We literally, let's say I'll use personal loans as an example in the queue. So let's say a $100,000 personal loan comes through. It could be a launchpad loan for those that are familiar with those loans, which are for first-time buyers and help them with a deposit. We will literally place that into the market, and it starts matching from the first person in the queue. So let's say the first investor has an order for $500. They'll get the first $500 of that loan as an investment. The next person might have $10,000 as an order, so they'll get that $10,000 at that point matched. Next person might have another $500, so that 500 gets matched, and so on until that 100,000 is matched by loans in the queue. That might mean the person who's last in the queue, they might have a $10,000 order, for example, but there's only $5,000 of loan left available. So we'll match $5,000 to their investment, and they then sit at the front of the queue with their remaining $5,000 for the next loan and wait for that one to come through. Henry, I hope that answers that question. Feel free to follow up with another one. Good to see some more questions rolling through, so I'll keep asking them or reading them out and then answering them as we go. So this is a question from Mark. Do you have a view in terms of Auckland value declines through to the end of the year? Currently, it's running at 8%. It's a good question. If you look at what economists have said, so if you go to the main banks and you hunt out their economic commentary, all of those economists have a view, and they've talked about drops in house prices anywhere from about 5% up to about 12%. So if we base it on what economists are saying, then somewhere in that range of 5 to 12%. Currently, the 8% that was in my presentation, that comes off median values, isn't always the best indicator. I expect house prices to be, if this is me personally, based on what I know of the market, I expect we'll see prices down from their peak. So remembering that the peak was probably September, October, November last year, we'll be off by somewhere in that single digits, but high single digit space. And if they're already down 8%, we may well find that we find a floor in the market at around that level where loans are at the moment. The reason that I say that is there is still people buying. People are still getting approved for loans every day. There is still demand for houses. It's just that things have evened out, and we don't have this FOMO or fear of missing out that was going on during the last 18 months over time. So I think we're close to a even match of supply and demand at the moment, which suggests to me that prices won't fall a lot further than what they've already falling. But hey, that's just an opinion, and the truth will be in the data that comes out. And Mark, you can write to me at the end of the year and tell me how well I did with my prediction there. Okay, next question. This one is from Steve Green. Would you be willing to sponsor a short-term bridging loans for investors looking to move house? Steve, you can apply through the Squirrel website on that front, and one of our advisors will pick that up for you. So hopefully that helps you with that one, Steve. Thanks for the question. Next question I have here is from Spencer. Do the reserves to cover defaults go into a separate fund? If so, will you eventually be able to keep that as a reserve and reduce the risk premium? Great question, Spencer. So first part of that was, does the money for the reserves go into a separate fund? And the answer to that is yes. So that money sits in a bank account, which is managed by Squirrel peer-to-peer trustees and is held on behalf of investors, okay? So it's not Squirrel's money, it's effectively held on behalf of all investors in Squirrel investments. In the event that we shut up shop, that money is actually given to Starship Hospital, and you can see that in our trust deed. So that money is kept and held separately for investors, and it's literally in a bank account. Each of the bank accounts earns a small amount of interest, and that interest is put back into the reserve fund each month. So second part of the question, could we lower the risk premium over time if we find that reserves grow to the point where there's plenty of money available should loans go bad? The answer to that is yes, that may be something that we do in time. At this point, the Personal Loans Reserve Fund is just over 6 years old. it has a very high coverage ratio. So the current coverage ratio in that portfolio is running at about 5.6%, which you would say is actually quite high. Although in the last month or two, we've actually started to see that portfolio growing again. If we find that we get to a coverage ratio of somewhere north of perhaps 7%, then we may find that we start reducing the amount that we reserve and increasing the returns back to investors. It's something that we do very, very carefully though, because there's a lot of modeling that's gone into figuring out what those reserving rates are and preparing for the worst of times, okay? And so what might the worst of times be, for example, for the personal loan portfolio? That would be unemployment rates up at 10% or more than 10%. If you've got rates up there, then it's conceivable that we would start eating into that reserve fund, and the balance of that reserve fund would drop. Now, it would drop slowly. It's not going to, plummet overnight down to zero or anything like that. But over the course of a year, you could see that the total balance in that reserve fund actually decline if you've got unemployment rates up at 10%. And then you assume that the portfolio is impacted, by the market and the market failing at that point. So that's a really good question. Thanks for that, Spencer. Let's keep going. Are the balances held in reserve funds at or in excess of the target levels? So if you look at the reserve fund, the amount that we reserve each month is running at about 45 basis points or 0.45% for home loans as it stands today, and around about 60 basis points for our construction loan portfolio, and around 2% or 200 basis points for personal loans. So they're running at levels that I believe are about the right rate for us. For personal loans, because that portfolio has been running for a lot longer, it's in a more comfortable position. So the coverage ratio, which is the other core ratio that I look at every single day, for home loans is a bit over 1%, and for construction loans is a bit under 1%. And the reason is because those portfolios have grown relatively quickly compared to the amount that's been reserved in each of those loans over time. So that's the reason that they're a bit under 1% for construction loans and just over 1% for home loans. We keep an eye on those pretty closely. And I'd expect over time, assuming the portfolio continues to perform, that you'll see those coverage ratios grow. Now, the coverage ratios and the reserving levels is information that's held on our website, and you can find that on the investments page. So that data is updated every day. Thanks for that question, John. Next one is with relation to investors and their individual investments held on an allocated basis, or is it held unallocated in an aggregate pool in a trust by the trustee? All right. So if you are a peer-to-peer investor with Squirrel holding term investments, then you're allocated on a one-to-one basis. Okay. So if you place an order for $10,000 and that is matched to one loan, then your investments are held in just that one loan. Key thing though is from a diversification and credit risk perspective, you have the reserve fund backing you up and managing that credit risk for you, which we believe is a good thing, which means you don't have to be a credit manager to determine whether you want to invest in a loan or not. If you like the look of the investment class, then it's that reserve fund that's providing the backup for you to help manage that credit risk. If you're an investor in the managed fund, so Squirrel launched the Squirrel Monthly Income Fund in November last year, which currently has about $4 million in it, give or take. That fund, you're in a pool of investors, and you hold that pool of investors collectively holds investments across a whole range of loans with Squirrel. That includes home loans, construction loans, and personal loans. So it's a pooled investment, albeit that each investment is matched from the investment fund to those loans that are in that pool. The managed fund invests fractionally on our platform, so that means that we'll have a share of loans just like any other investor. So thank you for that question, and I'll keep moving. Next question is from Vicky. Hi, Vicky. What's the current wait time for resale of construction loans on the secondary market? Alrighty. So 2 parts to the answer here. I wrote a blog post about, it was before Christmas, so let's say 5 months ago, which talks about how the secondary market is performing. It might be worth for anyone who wants to read up a bit more about that to have a look at that blog post. As far as we're currently going, for home loans we're seeing sell through the secondary markets. It's an investor selling a home loan. That's taking 2 or 3 days to clear. For construction loans, equally, that's 1 to 2 days on average. And for personal loans, they are rolling through very quickly. If the loan that you're invested in, that you're wanting to sell, has had an arrears event on it, then we need to ask permission from investors to be matched to that loan. So that can slow things down a bit. And so it might take anywhere from 2 to 5 days for an investment that has had an arrears event to clear. If a personal loan hasn't had an arrears event, then it would clear the same day. So a bit of a mixture there, but it's taking a couple of days, you assume, on average at the moment. Thanks for that question, Vicky. It looks like we've got a question from Paul. So Paul's question: what would be a better way to measure house prices if the median isn't great? So in my mind, Paul, I think you need to stratify the market in some way, shape or form. So maybe you track the house price for the lowest quartile, the 2 middle quartiles and the upper quartile, and watch what happens in there. So, anecdotal evidence would suggest that house prices have dropped a little bit at that bottom end of the market. And that's where the bulk of that loss that we've seen in house prices in Auckland has come from. At the top end of the market, though, houses are actually still selling at pretty reasonable prices. So I think one median for the whole of the market doesn't really tell the story. And I think stratifying it in some way, whether it's into deciles or quartiles, I think would be a far better way to look at it. And the average can also be misleading. I saw a headline on Stuff yesterday, case in point, that says the median house price in Auckland had dropped by 39%. Now, when you actually dig into what they were actually looking at when they said Auckland, what they meant was pretty much Auckland CBD or downtown Auckland. And a huge number of relatively cheap apartments had been sold in that month, which dragged that median down a long, long way. And, I'm not sure Stuff's headline did justice to it, what's actually going on in the market in that sense. Paul, hope that answers that question. Happy to continue taking questions on that one. Next one that we've got up is from Marion. When putting in orders in construction loans platform, how do we prevent one borrower picking up multiple orders over a number of days when we're all trying to fractionalize our investments? How do I answer that one? So I think the easiest way to describe it, Marion, is that the way that our order queue works is it's time-based, okay? So if you're an investor with $500 and you're at the front of the queue, then next time a loan is placed on the market, you are the one that will pick up that loan. So it doesn't matter whether you've got $500 or $500,000, you're treated the same as far as getting into that queue goes. And maybe this is where you're going with that question, Marion. If you're trying to spread your money across a range of loans, so I'm making some assumptions here that maybe that's what you're trying to get at, probably the best way to do it is to place orders over a period of time. So you're going to drop orders in, let's say, once a week or once every couple of weeks. And that way you're almost guaranteed to spread your money across loans if that's important to you. With Squirrel and the way that we operate, in my view, I don't believe you need to try and diversify the number of loans that you're invested in. The reason for that is that the reserve funds step in the event that any particular loan goes bad. The reserve funds step in and make investors good. Now, the reserve funds aren't guaranteed, as you'll see everywhere in our website. However, losses are socialized across everyone, in effect, using that reserve fund. So you don't actually need to try and split up your orders, in my view. So if that's what you were getting at there, Marion, hopefully that answers your question. Feel free to clarify your question a bit further if I didn't quite answer it in the way that you expected it to. Yeah, so two parts there. First of all, everyone is treated the same regardless of the size of the orders that you're placing. And then the second one is, if you're trying to split your investments across a range of loans, then the best way to do that is to place an order once a week over a period of time. Although I'm not sure you necessarily need to do that, would be my view, because the reserve fund is standing behind you. So you can, invest 100. Your risk of investing 100,000 in one loan is the same as investing 10,000 in 10 different loans because the reserve fund is there. So thank you for that, Marion. All righty. I'm going to keep on going. Thanks for those questions coming through. It makes my life a whole lot easier and makes the session a lot more interactive. Question from Adrian. Could you cover Squirrel monthly income fund information and its performance to date? Absolutely. So we launched the Squirrel monthly income fund in November last year. At this point, we have launched it only on the Invest Now platform. We're intending to launch that through financial advisors on a host of financial advice platforms over the next 6 months. Performance so far, so we have about $3 million in the Squirrel monthly income fund, and we have some wholesale funds that sit underneath it, and there's another $1 million or so invested in there. So in total, across the suite of managed funds, there is $4 million invested. Its performance so far, it's done what we said it would do on the tin. So we said it would deliver a return, which is about 4% over and above what the official cash rate is. And so far, that's what it's delivered. With interest rates going up over time, we're seeing that rate of return go up. With the interest rate increase that was put through for investors, including managed fund investors yesterday for home loans and construction loans, that's going to see the return for the month of April be up around about that 5% level for the managed fund. So it's going along quite nicely. I'm quite happy with the performance of the fund at this point. We've got a nice spread of loans from across the home loans, construction loans, and personal loans in the fund as it stands today. Hopefully that answers your question there, Adrian. Appreciate that one. Moving on. Question from Judith. Would you expect defaults with rising interest rates? I think, so if I talk about the market first, and then I'll talk about Squirrel specifically, Judith. So with the market overall, the thing that would cause defaults to kick in more than anything else is unemployment. So if we saw unemployment start spiking, and I'm talking, at the moment, we've got the lowest unemployment rate New Zealand's ever had, right? So we're at 3.9%, which is, to anyone who's studied economics out there, would say that's full employment, rightly or wrongly. So with those default rates, the thing to really watch, particularly related to residential housing and personal loans, is unemployment rate. It's really low right now. If we saw unemployment rates starting to head up above about 6%, there's going to start to be some pain felt at a New Zealand market level. So that'll be something to keep your eyes on there from a market perspective. If we think about Squirrel, one thing I should say that applies both to the market and to Squirrel, when we assess a loan, we don't assess it on the interest rates that are available now. There is a benchmark rate or a test rate in play, and you may have seen commentary on that in the market. So if you're a main bank or Squirrel today and you're looking at a test rate, then the test rate that would be running is probably about 6.5%. So we're assuming that interest rates will rise. And I think it goes back to what I said earlier in the presentation about, your credit policy being written for the bad times, not the good times. So we plan for interest rates to be up at that level. If interest rates go beyond that level, and you're seeing the unemployment rate in New Zealand starting to rise, you'd expect defaults to start to increase off what is an incredibly low base as it stands today at a market level. Hopefully that answers your question, Judith. Feel free to follow that up with another. Next question from Paul. If the risk of credit default is so low, if I understand how come if I've understood, how come home loan interest rates are so high? So why are interest rates so high on the borrower side? So let's assume that a borrower in the market today for a home loan, if I talk about market, right? So market home loan rate with a 2-year fixed rate is going to be about 4.5%, give or take. And for Squirrel borrowers, that rate's probably for a home loan investment class, probably more about sort of around 6% today. Key thing is, how much does it cost to fund? And when I say fund, I mean how much do we need to pay investors in order to bring that money in so that we can pass it on to the borrowers? And that's predicated by a few things. So one of the indicators is where the Reserve Bank's official cash rate is. The second indicator is where wholesale interest rate swaps are at in the market. So we've seen interest rates rising because the Reserve Bank is basically saying they expect the official cash rate to go up over time, okay? And so that means that all lenders are effectively pushing up their rates for borrowers, and that also means for investors, they're getting the benefit of those higher interest rates. So credit default and interest rates are two slightly different things. Credit defaults, or the amount that you might reserve against a loan, if you expect the risk of that loan to be higher, then the amount that you would reserve against that loan would equally be higher. Same thing with lower rates of interest. If I contrast that in the market, if you look at credit cards today, you see credit card interest rates somewhere between 13 and 20% across the market. And part of the reason that those rates are so high is because there's a lot more risk. There's a lot more people who don't pay their credit card bills. If you contrast that to a homeowner today who's getting interest rates of somewhere between, let's say, 4.5% and 6%. So the absolute level of interest rates is reflecting the amount of underlying risk on loans. So credit default risk is a bit different to interest rates. So hopefully I've answered that question for you, Paul. Feel free to follow that one up if I didn't quite hit the nail on the head for you. Next question from Francesca. How long do you need to wait for loans to come up in construction? There is more money available than loans requested. So for our construction loans today, we have loans in stock. So what does that mean? Squirrel has a loan facility with one of the major trading banks in New Zealand. And that facility's got a limit of around about $30 million in it. And so we happily go along and write loans. And then as there is demand from investors, we pass those loans on to investors. So as it stands today for construction loans, I think there is a loan, it's about a $1.8 million loan. And there's around about $800,000 left that investors can buy up of that loan. When that loan runs down to zero, we'll add another loan in, and all of a sudden we'll start back at, I don't know, a loan of $1 million, could be $1 million, could be a few $100,000, could be up closer to 2 million. But we've got lots of loans in stock, so we'll keep feeding them through for home loans and construction loans. So you can literally place an order for loans, or place your investment order, and we'll ensure that that's matched on construction loans and home loans. If you have to wait more than 24 hours for that order to be matched, I'd be really surprised. Maybe we might get caught out on the odd weekend where we didn't have enough loans available for investors investing over the course of the weekend, but that's pretty rare. We're normally making sure we feed loans through all the time. So you shouldn't have to wait. All you need to do is place your investment order, and that should match to loans that are available. Thanks for that question, Francesca. Oh, sorry, one thing I might just add to that actually is for personal loans, we can't write enough loans to satisfy the demand from investors. And so there is a wait time. Those wait times are probably the lowest they've been for a while. So the 1 year personal loan wait time today is probably a couple of weeks. And the wait time on 5 to 7 year personal loans has got down to about 2 weeks. It might be just expanding out to about 3 weeks at the moment, but it's down at 2 or 3 weeks to get yourself to get yourself invested for personal loans. The 2 to 3 year personal loans They are a bit slower. So, you're going to be waiting a bit longer. I probably wouldn't recommend going in there right now. There's quite a bit of money in the queue and it's taking a while for that to move. Rightio. Next question. Is there a lot of new house building going on at the moment compared to other times? Will we end up with an excess of supply in 2 to 3 years? I guess if you look at building consents, probably the easiest way to look at that information. Building consents are as high as they've ever been in the market right now. The volume of houses that come on stream in the second half of this calendar year will be the highest, I believe, ever in New Zealand. So there are a lot of houses being built right now, and partly that's why you're seeing supply shortages, because there's just so many houses being built. One of the interesting things, though, is that those houses, the vast majority of those developers needed to have pre-sales in order to get their development off the ground. So those houses that are coming on stream, many of them are actually already sold. So will that mean there's a supply-demand imbalance? Not necessarily. I guess there's a big question from an immigration perspective. So as New Zealand opens up its borders, does that mean we're going to end up with a net number of people arriving or a net number of people leaving? And we don't know the answer to that right now. I'm not sure anyone can kind of predict exactly what's going to happen. There are developers still looking to build, and if you believe main bank economists, they will tell you that we still have a supply shortage, albeit that shortage will get somewhat caught up over the course of this calendar year. So there's probably still a slight excess of demand relative to supply, but that it's much more imbalanced than what it had been in time. You'll probably also find some regional variations to my answer there. So, if you look at different parts of the country, then you'll get different answers, I suspect, Paul. To finish off the last part of your question there, will we end up with an excess supply in 2 to 3 years? That's really hard to predict. If you look at how long it takes to go through the consenting and building process, you're looking at often 12 to 18 months. So 2 to 3 years is probably too far to look out. You're probably looking more on the 12 to 18 month zone of what that supply demand balance might look like. And I'd say one of the big drivers is actually what happens to migration over the course of this calendar year. Thank you for that. Next question is from Paul. Are the wait times published on our website anywhere? At the moment, we don't publish what those wait times are because that would end up turning into a forecast and could be wildly inaccurate. What we do is on the investments tab on our website, we will show you how much has been invested over the last 7 days. So there's a graphic on our website on the investments tab that you can scroll through, so you can look at in total how much has been invested over the last 7 days with Squirrel. You can look just at home loans, just at construction loans, and then each of the 3 personal loan terms. So if I recall correctly, if I look at that 5 to 7 year personal loan term today, it will show you that there's been about 350,000 of new loans settled in the last 7 days. And there's about 350,000 of money in the investment order queue. So that, in theory, if you said the volume of loans that we wrote in the last 7 days is going to repeat in the next 7 days, then you would say, well, you shouldn't be waiting more than a week. However, I'd suggest that based on what I can see of the pipeline of loans coming through, it's probably 2 to 3 weeks for that 5 to 7 year term. Equally, we always have loans available in that home loan and construction loan space, so you'll get invested straight away. Thanks for that question there, Paul. Next question from Fong. How long does it take to withdraw funds? So there's probably a few different answers to that question depending on your situation. So if you are going to use the secondary market, so let's say you have invested, you're 6 months into a 12-month investment, let's say, and you want to get that money back, and you list your investment on the secondary market, you will today be waiting probably 1 to 2 days to clear that investment. On average, that's what we've seen over the last let's say 9 to 10 months. On average, it's taken about 1 to 2 days for people using the secondary market to clear their investment. There might have been the odd example where it's taken a bit longer. I generally suggest to investors, if you need to get your money out and you know that when you need to get it out by, allow yourselves 2 to 4 weeks ahead of time. The secondary market is not guaranteed for investment sales. However, if we look at track record, we're seeing investments turn over really quickly through that secondary market. I did a blog post, which you can find on the Squirrel website, and I think it was November last year, which gave lots of stats about the secondary market and how quickly loans are turning over month to month. And I'm actually going to look and see if we can incorporate that information on our website, so we make that more transparent for investors. So that's if you've got an investment. So the second part to this answer is, if you have money sitting in your Squirrel call account and you want to withdraw that back to your bank account, then that should happen same day on days when the banks effectively have their doors open. So if we assume Monday to Friday or business days, you'll see that money back in your bank account, typically within 2 hours of you making that withdrawal, 2 to 3 hours. So same day is the answer on withdrawing money from your Squirrel call account. Thanks for that question, Fong. Got another question here from Nick. As default rates start to climb, do you increase the target reserve levy on existing loans? That's something we would consider. However, we'd have to see a really bad recession coming in order for us to do that. We believe we're reserving at about the right level for the long run. And we're obviously clearly monitoring that. We've been in a really benign credit environment. If sure as night follows day, that will not be the same forever. So we would monitor that, or we do monitor it and manage it. If we saw a really severe depression coming, then we may well increase the amount of reserve levy that we're taking at any given time. And if things go really, really pear-shaped and it looks like the reserve fund may run out of money, then this is an extreme example, or at the very extreme end of the curve. We can call active management. So what does active management mean? That means that we would stop paying interest to investors, and we would use all of the returns from the loans that were making payments to recapitalize a reserve fund. And so that may mean that investors don't end up with a return over, let's say, a 6 to 12 month period while that reserve fund was recapitalized. We wouldn't expect there to be principal loss in that situation based on all of the modelling and the extreme scenarios we've thrown into the mix as we've looked at things. Thanks for that question, Nick. Okay, it looks like I am getting towards the end of the questions that have been asked today. Some fantastic questions asked, so I really appreciate those questions asked, and hopefully you've appreciated having that opportunity just to ask them on the fly. I'll give it 30 seconds and see if any other questions pop up. Otherwise, we'll call it quits there. So as I just wait to see if any last questions come through, thank you very much for your time. I really appreciate you dialing in. Hopefully you got something out of it. I've recorded today's session, and we will pop that up on the website sometime over the next week or so. Thanks for your time. Haven't seen any other further questions. We'll call it quits there. Enjoy the rest of your evening. Thanks, team.